Hello, I'm Michele Suriano, president of Castle Rock Investment Company. It's April 14th, 2025, and I'm recording today because every day I look at the market, it's changing so much, and I had to put a bow on the first quarter review and get this done and out to you. So I'm going to go ahead and share the first quarter report. Bring that up now. So if you're part of the pooled employer plan already, congratulations. We're going to go through those investments as well. And I also have information for anyone who's thinking about joining. So just to go over the basics, what is a pooled employer plan? It's just a retirement plan. It's new from the Secure Act of 2019, where unrelated employers can join the same plan. So we get efficiencies of scale. So the providers in Castle Rock PEP are Slavic 401k, Castle Rock, American Trust Company, and possibly your firm, of course. And this just provides the detail. And as you can see, all the benefits, if a bunch of small businesses get together or large businesses, the PEP can handle businesses of any size. We get the efficiency of that and scalability and share the resources available. Why Castle Rock PEP? Obviously, woman-owned, independent. I started the company in 2006, and I have a lot of goodies that a lot of other PEPs don't. I offer complimentary financial planning software. Also, we are going to start having community spotlights, community challenges. I offer complimentary one-on-one individual advice sessions as well when you belong to Castle Rock PEP. So 2025 employee limit. So if you were forced into Colorado state plan or any other state's mandatory plan, it's just a Roth IRA basically. But in the PEP, you have the same limits as a typical 401k plan. So as an employee, 23,500 plus an additional catch-up contribution if you're of a mature age like I am, and also employer contributions. So the total can be close to $70,000 or more. So that water cooler wisdom that I mentioned. Unemployment rate when we ended the first quarter was approximately 4.2, CPI running about 2.4, PPI 2.7. We do believe there was a contraction in the first quarter running about 2.4%. We don't get those official figures for a while. Fed funds rate, as you know, running around 4.25 to 4.5%. In the first quarter, stock market did lose money. Large caps, S&P 500, 4.6%. Russell 2000 lost a lot more, 9.8%. When believe we're going into a recession, is very common for small companies to get hit harder. A Bloomberg U.S. Aggregate Index return of 2.8% on the bonds. Quick update on our reciprocal tariffs. So again, remember, when do we do this screenshot, right? So this is as of yesterday, Sunday, April 13th. So the 10% that went into effect on April 5th, those are still in effect. The reciprocal tariffs from April 9th, those have been on pause. Yale's Budget Lab estimates that is going to cost each household approximately $4,700. Increase the unemployment rate about 0.55 and decrease GDP approximately 1.1%. Now, student loan debt, if you've been watching these in the last few quarters, you know, for almost a year now, I've been talking about the student loan debt. It was on pause during COVID, and they've had the on-ramp for a year. And that $1.6 trillion of debt just hit the credit bureaus in the first quarter of 2025. So just recently, those 43 million Americans with student loan debt are seeing that debt on their credit report. So this is huge. The median balance, 19,000, average account balance, 36,000. That is equivalent to all the all the auto loan debt in America. Now, prior to it, that debt becoming public and being reported to the credit bureaus, it was considered shadow debt. And the New York Fed did have a report that as of last September, that shadow debt, the delinquency on that was about 15.6% of the borrowers were past due. That was 9.7 million borrowers totaling $250 billion. That information, I mean, if you track this stuff closely, it was made available, but it wasn't on the credit bureaus, and now it will be. So that tariffs are one headwind, but this was a real headwind that was concerning me for the past year. You can find the Fed's blog at Liberty Street Economics. Also, the impact, what they assumed would be the impact on credit scores for those uh, before the delinquencies show up and then after the delinquencies show up. So headwinds, as we're going into the remainder of 2025, new debt showing up for 43 million Americans, obviously a decline in disposable income, $4,700 per household. That's prior to them substituting for cheaper goods. Impact may be higher unemployment, higher inflation, and lower GDP. Next time the Fed meets is scheduled for May 6th through the 7th. Yes, my degree is in economics, a dismal science. So as you can tell, sometimes that plays through. Have some quotes from the Fed here. They believe they have the correct monetary policies in place for what we're facing. So here's you just showing some performance, some returns. On the right-hand side, you'll see the PE ratios versus the 20-year averages. And as you can see, even as of the end of the first quarter, we were still running over 100% on PE ratios versus the 20-year averages for most type domestic companies. And then performance of the Mag 7 that we look at. I still left this at March 31st. Every time I wanted to update it, it just didn't seem to make any sense. So year to date, the return on the S&P 500 was a -4. If you took out the Mag 7, it was actually a positive return. The Mag 7 actually share of returns was 105% of the overall performance. And this periodic chart just showing you on commodities, best performing asset class first quarter, and then of course, emerging market equity. Moving on then, on the investments in the PEP. So the default are the Vanguard Target Retirement Funds. And as you can tell, I try to show this chart each time. So if you have a long time before you're going to retire, the default has a lot in equities, domestic and international stocks, approximately 90%. The concept then is to decrease your equity position or your stock holdings as you become more mature like me. So you don't have to wonder about, oh goodness, what if the stock market declines 40, 50% in 1 year and you're all in stocks? So it's going to increase your bond position as you get closer to retirement. And by the time you retire, have only about 30% in the equity market. And how it works, if you just go with a default, they find the year of your birth and match you up to the fund that is closest to the year you're going to retire using a moderate risk profile. It's pretty simple. The rest of the pages in here, there's some investment review giving you performance and the rankings versus their peer groups. For example, this Vanguard Midcap Index Fund, the return, it was a negative return in the first quarter, -1.58. For the 1-year return, 5.14, ranking in the 9th percentile versus its midcap blend peers. 3-year average annualized return, 4.51, ranking in the 37th percentile versus its peers. And you can look through the report. It is on the website if you want to look at the details on each of those investments. Of course, let's look at maybe a target date fund. So Vanguard Target Retirement 2045. So that's 20 years out from now. So that's pretty aggressive still. The return in the first quarter at -0.4%. 1-year return, 6.57, ranking in the 14th percentile versus its peers in that peer group. 3-year average annualized return, 5.9%, ranking in the 33rd percentile. Okay, there was one fund that did stand out. It underperformed in the first quarter and slightly in the last quarter of last year. The GQG Partners Emerging Market Equity Fund. GQG stands for Global Quality Growth. So the lead manager actually founded the firm in 2016. He has a fairly large team right now working for him. But a couple of things that make this fund unusual. Largest country holding was India. at 34% versus category average of 17%. United States holdings was larger, 12% versus the category average of 2%. And Chinese holdings only 10% versus category average 26%. It'll be interesting to see how this plays out in the next month, 2 months, 3 months, as we move into the second quarter of the year. The Morningstar does provide a medalist rating of gold for this fund. So it'll be interesting also. The portfolio does have 7 Russian companies in it, including Gazprom. And it will be interesting because they have a value of 0. We sanctioned Russian companies, so they cannot have a value here. So it'll be interesting how that plays out over time. On this slide, we're simply looking at the expense ratio for each of the investments in the plan. Then the cost overview for the pooled employer plan expenses. Now, there are asset-based fees and then also hard dollar fees. So typically, this is the one that impacts you the most, that $35, which is $8.75 a quarter. That's the one you're going to see the most until your assets really grow. But this gives you that glide path on the asset-based charges. But then, of course, we get to tax credits, which everybody knows I'm a big fan of tax credits. So if you have a startup cost for joining a pooled employer plan, of course, you'll have a tax credit for that. Everybody needs to have, of course, automatic enrollment in their plan design. There is a $500 tax credit for 3 years for offering that. And then the employer matching contribution. So as an employee, I contribute. As the employer, I'm matching those contributions. And the first $1,000 matched on the employee contribution is a tax credit. So if you've not set up or joined the PEP, you want to join the PEP, please schedule a PEP talk with me. Or if you're ready to go ahead and set it up right away, you know which plan design you want. I use this second one listed here, the 100% match on the first 1% saves, 50% on the next 5. It has a 2-year cliff on it. The reason why, as a lot of you know, I had an employee and he quit after only 1 year of service, and I'd rather have that money back that I gave him. So I like that 2-year cliff. So you have to have 2 years of service before the employer match is fully vested. So if you know one of these designs works and you just want to get it set up right away, it takes less than 15 minutes. I just did it today with someone. It's super fast and easy to do. But if you want a different type of design, let's say you just want to make a 2024 profit sharing contribution, because the books are mostly closed for 2024, so you can't do a payroll deferral. But if you want just profit sharing contribution, there is a website. You can download those forms, fill them out, and upload them. I definitely recommend still scheduling a meeting with me so we can discuss what is going to work best for your company and to attract and retain the talent that you need. And the rest of the report, I'll let you go through it. Some credentials. Please don't be impressed. I'm just very old, so I have a lot of credentials. And then the standardized investment performance and some regulatory disclosures. Well, I want to thank you for your time. Thank you for reviewing this video. And hopefully all things go well with our market and with your savings and with your tax credits. Free money for all, hopefully. Thank you again. Bye-bye.